Good evening, everyone. Time for another silver update. This is the daily chart of the US dollar over the Chinese yuan. That's the Chinese currency, which is still essentially pegged to the dollar based on a fixed floating rate. It's allowed to move in bands, but again, it's a pegged currency. It's not freely tradable right now, but you can see a couple of things in this chart. I just want to point out that this is the signature that you see when you're talking about a rigged market. And of course, that's the problem that we have now in the entire world, especially in the United States, is that all of the markets are rigged. We have government intervention in markets, and the only thing that can happen as a result of governments intervening in markets is absolute disaster. That's what we're heading for. Now, if you look at this chart, you can see during the year 2010 from late 2009 through about June, we had this peg. This was central bank pegging of these exchange rates, and then you can see when the peg was finally broke, there was the breakdown, the reaction, and then of course the long downtrend. Now this sort of thing is this is normal market behavior. Then we come down here and we get the same thing here. This is another peg that the central banks have set where they're controlling, not allowing the currencies to freely be traded against each other. And of course that is unnatural because the fundamentals are going to dictate the value of currencies, relatively speaking. Now you can see they had a breakdown and then they had a trumped up rally, of course, that failed. That will always be the case. And now you can see where we are right now in the exact same situation. We have this artificial peg of the Chinese currency at 6.11 to the dollar. Now I've said for a very long time that this is going to one-to-one parity and beyond, and that's going to mean ultimately the death of the dollar. But just to think about these things, what does this mean? Now, a lot of talk has been given about how the Chinese are going to have to suffer tremendously as their currency strengthens. You have to remember that as your currency gets stronger, that means that your exports are more expensive and your imports are cheaper. So in this case, where the Chinese currency is strengthening against the dollar, that means that Chinese exports will become more expensive, exports to the U.S., and we pretty much import everything, and a large amount of it is from China. If you go to Walmart and just start looking at things, you can see how many are manufactured in China. That means that prices on those goods are going to go up as the Chinese currency strengthens. Now, if there were an equilibrium where it reached fair value, what you would start to see is an increase in manufacturing in the United States because it would become cheaper to manufacture the goods here. Obviously, that's not happening, so that is nowhere near reaching any kind of fair value. They're still propping up the dollar versus the Chinese currency. Now, the other side of that is going to be how the Chinese have cheaper imports. Now, that means oil. So as the Chinese currency strengthens, one of the main inputs they need, because they have all of the factories, is oil. And that means that oil is going to get cheaper and cheaper. And of course, we know that they're already doing bilateral trade agreements. There's the Iran and Syria thing going on. But if this trend continues, which I'm sure that it will, as I've said, it's going to continue all the way down to one-to-one and beyond, then that means that oil is going to get cheaper and cheaper and cheaper for the Chinese. And the manufactured goods, on the other hand, are going to be more and more expensive for the Americans, and I don't see that trend turning around. There's no reason for the Chinese to not be able to raise their prices on those and be able to